Hello everyone, welcome to Tesla Daily News. Today is June 7th, Saturday, and the following is the latest Tesla news. According to Reuters, as summarized by Clean Technica, former Tesla full self-driving staff and independent safety researchers are raising serious doubts about Tesla's autonomy strategy and safety claims. Reuters interviewed a former self-driving engineer and 9 former data labelers who worked directly on Tesla's FSD system, along with 11 independent traffic safety researchers. These former insiders describe an FSD development process far more fragile and localized than Elon Musk and many Tesla bulls have long claimed. Instead of a generalized system that can simply be switched on anywhere, they say Tesla often needed many hours of human-intensive training and route-specific tuning to make FSD behave well enough for demos and events. Reuters reports that workers train FSD obsessively on specific routes to ensure good performance, implying that these safeguards and manual labeling efforts are not scalable to nationwide or global deployment. This sharply contradicts years of messaging from Musk and Tesla supporters that FSD would soon work everywhere without high-definition mapping or geofencing. For a decade, Tesla's approach was contrasted with rivals like Waymo, which openly embraced geo-fenced operations. Yet, as Tesla's first robotaxis have begun limited operations, they have in fact been geo-fenced and constrained to small, controlled fleets rather than broadly available across all owner vehicles. Out of 9 former FSD data labelers Reuters spoke with, 7 reportedly said they would not trust FSD to drive them, and 1 said he would refuse to ride in a Tesla robotaxi even if paid. That level of internal skepticism is striking for a company whose valuation heavily depends on autonomy. The Reuters reviewed safety analysis is equally troubling. According to the researchers cited, Tesla has been benchmarking its safety performance by comparing only airbag deployment crashes for Teslas using autopilot or FSD with a federal crash database that includes less severe incidents for the general car population. On top of that, Tesla compares its relatively new fleet against the much older average American vehicle, which tends to be less safe. 10 of the 11 researchers told Reuters that Tesla's public safety methodology reads more like marketing than rigorous safety science. For investors, this matters on multiple levels. First, it raises questions about the technological readiness of FSD for broad unsupervised deployment, even as significant portions of Tesla's market valuation and bullish analyst models assume robotaxis coming relatively soon. Second, any perception that Tesla has been cherry-picking safety stats could increase regulatory scrutiny and reputational risk, especially in the United States and Europe. Finally, if FSD is more localized and labor-intensive than advertised, near-term margins and scalability of an eventual robotaxi network could be more constrained than many equity models assume. According to Times Now, a detailed analysis of Elon Musk's public promises by the New York Times suggests that many of his ambitious technology and business timelines have slipped or gone unmet, with Tesla autonomy and robotaxis as a prime example. The Times reportedly reviewed more than 69,000 social media posts, interviews, and public statements spanning roughly 15 years, and extracted over 600 specific, deadline-linked business goals across Tesla, SpaceX, Neuralink, XAI, and the Boring Company. The analysis finds that only a minority of those dated goals were achieved on the original schedule, a sizable share were achieved late or not at all, and many others were too vague to measure. Notably, Musk's on-time delivery rate for his public targets appears to have declined over time. In the mid-2010s, a large majority of dated goals were met on schedule, while by around 2020 fewer than half reportedly arrived when promised. In the Tesla context, the clearest example is full self-driving and robotaxis. Musk has repeatedly said fully autonomous driving is just around the corner, and has publicly floated timelines for hands-free, unsupervised capability more than once. While Tesla has clearly advanced its software and has started very limited driverless ride services in parts of Texas, a large, revenue-generating, fully autonomous Tesla robotaxi fleet has not yet materialized. For investors and enthusiasts, this analysis underscores a key risk. Musk's timelines tend to be best viewed as directional ambition rather than reliable schedules. While he has an extraordinary record of eventually pushing frontier tech into reality, witness SpaceX's launch dominance and Tesla's EV leadership, his public dates are often optimistic. Equity valuation that assumes Musk's earliest timelines will hit on schedule, especially for FSD, robotaxis, or humanoid robots, may need to build in more execution and delay risk than his public comments suggest. According to a detailed report in Fortune, Elon Musk has structured a massive new compensation package at SpaceX that both fuels media buzz and effectively cements his control over the company, even if some of the most extreme performance targets are never met. This SpaceX Mars Shot award is separate from Tesla, but it has important implications for investors in both firms. The package, disclosed in SpaceX's IPO registration statement, could be worth up to roughly $1.1 trillion at the very high end if virtually impossible milestones are achieved, including reaching a $7.5 trillion market capitalization, establishing a permanent human colony of at least 1 million people on Mars, and building data centers off Earth delivering on the order of 100 terawatts of compute per year. SpaceX itself describes some of these project-based goals as improbable. Critically, the structure of the award means Musk enjoys the voting rights from these massive tranches of super voting Class B shares immediately, even before the economic performance conditions are met. In other words, he does not need to colonize Mars or build extraterrestrial data centers to wield near-iron control over SpaceX. After the IPO, he is expected to retain over 80% of the voting power associated with the super voting class and the right to elect a majority of the board. SpaceX is now incorporated in Texas, not Delaware, which significantly raises the bar for shareholder lawsuits and concentrates legal disputes in a specialized Texas business court. The SpaceX prospectus clearly states that it will be a controlled company and will not follow all of the conventional corporate governance practices required of most large public firms. For Tesla investors, this matters in several ways. First, it signals Musk's strong preference for dual-class, founder-controlled structures and his determination to avoid a repeat of the Delaware court battle that temporarily voided his 2018 Tesla pay package. That battle triggered his very public campaign to rein corporate companies in Texas. Second, his deepening control and personal upside at SpaceX could influence how he allocates time, focus, and risk appetite between Tesla and SpaceX in the years ahead. Finally, the market's eventual reaction to a SpaceX IPO under such governance terms could become an indirect reference point for how investors value founder-controlled, AI and space-heavy platforms compared with Tesla. According to Finbold, which consulted a previous ChatGPT-based analysis, investors weighing Tesla against a future SpaceX IPO face a classic trade-off between proven revenue engines and higher-risk AI and autonomy upside. In that prior assessment, Tesla was characterized as transitioning from being valued primarily as an electric vehicle maker to being treated more as a hybrid of hardware, software, and artificial intelligence. In this view, long-term Tesla value hinges increasingly on the success of FSD, robotaxis, and the Optimus humanoid robot, rather than on vehicle unit sales alone. If Tesla can truly commercialize an autonomous ride-hailing network and robotics at scale, potential revenue could far exceed its current automotive business. However, the path to that outcome is neither guaranteed nor short. By contrast, SpaceX already operates robust, fast-growing businesses today. Its Falcon rocket launch services dominate commercial spaceflight, and Starlink has become a major recurring revenue generator globally. Future platforms like Starship could further expand the company's addressable market by slashing launch costs and enabling new classes of missions. The AI analysis cited by Finbold concluded that, as of mid-decade, SpaceX looked like the stronger fundamental business with more visible, diversified revenue streams, while Tesla offered greater upside but with higher execution risk tied to autonomy, AI, and robotics. For Tesla shareholders, this reinforces the idea that much of the company's premium valuation is now a bet on future non-automotive businesses that are still in the early stages of commercialization. According to the Sacramento Bee, relaying analysis from the street, JPMorgan has executed a dramatic shift in its stance on Tesla stock, moving from a long-standing bearish view to a neutral rating with a sharply higher price target. For years, JPMorgan's lead Tesla analyst positioned the stock as overvalued, often recommending underweight or sell ratings and applying traditional automaker valuation frameworks. That changed when Rajat Gupta, JPMorgan's new Tesla analyst, took over coverage in May. Gupta upgraded Tesla from underweight to neutral and raised the price target from about $145 to roughly $475 per share, a revision of more than 200%. The new target implies modest upside from Tesla's recent trading range and, importantly, withdraws the firm's prior call for major downside. The core of Gupta's thesis is that Tesla is best understood not mainly as an automaker but as a physical AI company. He highlights Tesla's deep vertical integration across hardware and software, from vehicles and batteries to in-house chips and data centers, drawing parallels to how Amazon used its internal logistics and infrastructure to incubate AWS. The note argues that Tesla's factories and vehicle fleet are a testbed for the Optimus humanoid robot and a future robotaxi network, creating a data and deployment flywheel that could support scale advantages. Gupta's team reportedly projects Tesla revenue could roughly double by around 2030, with a large portion of the incremental growth coming from FSD-based robotaxis, software licensing, and humanoid robots rather than pure vehicle sales. They expect earnings per share to inflect meaningfully later in the decade if autonomy and robotics scale as envisioned. However, the report is explicit about the significant execution risk. Tesla still has to secure regulatory approval for unsupervised robotaxis, demonstrate safety at scale, and solve remaining technical challenges in FSD. Musk himself has acknowledged that millions of existing Teslas would require upgraded hardware to support true unsupervised autonomy, which complicates earlier promises that current hardware was sufficient. By stopping at a neutral rating rather than upgrading to overweight, JPMorgan is signaling that while it now recognizes the legitimacy of Tesla's AI and robotics optionality, it is not yet confident enough in the timing and magnitude of those businesses to recommend aggressive buying at current prices. For investors, the bigger story is not the specific price target but the fact that a major house that long backed the bear case is now building FSD, robotaxis, and Optimus into its formal valuation framework. According to Commercant, looking back at Elon Musk's promises on Tesla robotaxis, one of the most high-profile forecasts remains unfulfilled, the pledge that there would be about 1 million Tesla robotaxis on the road by 2020. Musk originally claimed in 2019 that the following year Tesla would enable owners to deploy their vehicles as fully autonomous taxis through a shared network, generating income while they were not personally using their cars. In reality, the number of truly autonomous Tesla robotaxis operating today appears to be in the dozens, confined to early pilot programs and experimental fleets, while competitors like Waymo are now running hundreds of highly geofenced robotaxis across several U.S. cities. Tesla has begun rolling out a purpose-built cybercab design targeted at a future robotaxi service, but analysts cited in the Georgian report point out that the expansion has been slower and more constrained than early promises suggested. From an investment perspective, this is important because robotaxis have often been invoked to justify extremely bullish revenue and profit projections for Tesla. Each year that fully autonomous, widely deployed robotaxis slip further into the future increases the risk that some of the most optimistic long-term models may need to be recalibrated, or at least have their timelines extended. It also highlights how much of Tesla's current narrative rests on technologies that are still in transition from research and pilot phases to full commercial scale. According to Jutarnji list in Croatia, Tesla's second-generation Roadster has become an emblem of delayed promises. First unveiled in 2017 with spectacular spec claims sub 2 seconds 0 to 60 times, extreme range, and potential rocket-assisted performance, the new Roadster was originally targeted for production in 2020. Nearly a decade after that unveiling, however, the vehicle still has not reached customers. The latest reporting indicates that the Roadster's premiere has been postponed once again, with the earliest new unveiling window now expected in August. Over the years, the car has repeatedly slid down Tesla's priority list as the company focused on high-volume models, battery scaling, FSD, and new projects like the Cybercab and Optimus. The Roadster has been used in marketing, as a halo project, and as a symbol of Tesla's performance ambitions, but its long delay underscores the company's tendency to push high-profile, niche products back when resources are constrained. For shareholders, the Roadster's fate is not financially central. Its volumes and profit contribution would be modest compared with the Model Y, Model 3, or an eventual robotaxi fleet. However, it does affect perceptions of Tesla's credibility on product timelines. The Roadster, like many of Musk's long-running promises, illustrates the gap between visionary announcements and real-world manufacturing, especially when the company is juggling multiple capital-intensive bets simultaneously. According to Schwäbische Zeitung in Germany, a recent fatal accident involving a Tesla near Donnernhausen has raised fresh questions, though the investigation is still in an early phase. About a week after the crash, many details remain unclear, and authorities have brought in an expert to reconstruct what happened, a process that could take months. The initial police account says that a 75-year-old Tesla driver from Reutlingen appears to have lost control of his car shortly after accelerating from a traffic light. The vehicle reportedly veered left across oncoming lanes off the B2T, crossed a bike path and a green strip, knocked down a light pole, and then entered a drugstore parking lot, where it struck several parked cars. Tragically, a 73-year-old man standing at the rear of his Skoda was hit, dragged, and fatally injured. At this stage, investigators consider a possible medical emergency experienced by the Tesla driver to be the most plausible explanation, but they have not ruled out other factors. There is no confirmed evidence yet in public reports that Tesla's autopilot or FSD functions were active at the time. Nonetheless, such incidents tend to attract outsized attention when a Tesla is involved, given the company's prominent autonomy branding. For investors, the key takeaway is that each high-profile incident adds to the broader safety narrative surrounding Tesla and its advanced driver assistance systems, even when manual driver error or health issues may be the main cause. Ongoing accident investigations, especially in Europe, can influence regulatory attitudes, insurance pricing, and public perception, all of which feed back into adoption rates for autopilot and FSD. Together, these stories paint a complex picture for Tesla at mid-decade. On one side, major institutions like JPMorgan are beginning to model robotaxis and humanoid robots as real-value drivers, and Musk is entrenching control over his broader empire through structures like the SpaceX Mars shot compensation plan. On the other, industry researchers, former insiders, and delayed projects are highlighting persistent gaps between promises and current capabilities, particularly in autonomous driving and product timelines. For long-term investors and enthusiasts, the central question remains how quickly Tesla can close those gaps, commercializing FSD at scale, earning regulatory trust, deploying robotaxis and robots in meaningful numbers before the market loses patience with optimistic narratives. The outcomes of those efforts will likely define Tesla's trajectory more than any near-term delivery numbers. Thanks for listening to Tesla Daily News. If you found this episode helpful, please consider subscribing and sharing it with other Tesla followers and investors.